For the past slides, we're talking about the initial valuation of our accounts receivable. Next, we're talking about the subsequent valuation of accounts receivable. The value of accounts receivable is also subject to the different variations or different considerations. So accounts receivable is from the credit sales, although the company is entitled for the payments, but it does not mean the company will receive all the payments from the clients. In other words, some receivables will finally become bad debt or credit loss, and this is an inherent risk for the accounts receivables. So how to account for these considerations in the accounting information system? So one is direct write-off, which is very simple, but it is not allowed under GAAP. We focus on the allowance methods. The direct write-off methods, basically, we recognize the amount cannot be collected and credit accounts receivable directly. Because accounts receivable is an asset, when we credit this account's reduce, right? So this is amount accounts receivable will not be realized. This method is very simple. It has direct impact on the assets accounts receivable directly, but it has two shortcomings. First, it overstates the balance of accounts receivable in the period prior to the write-off. So this write-off actually is triggered when the company confirmed that this $15,000 will become bad debt. So the confirmation of the write-off is usually in the following period. So in other words, the receivable as an asset was overstated before we write off this amount. It also distorts net income by postponing recognition of any bad debt expense until the period in which the customer actually fails to pay. Before the company makes the journal entry for this write-off, the bad debt expense was understated, and also accounts receivable as an asset was overstated. If the company wait until the write-off is confirmed, the balance of accounts receivable in the current period is overstated. So we cannot wait. Instead, we use allowance methods. We will estimate the amount of receivables that could become bad debt in the future. This will mitigate the overstatement of accounts receivable for the direct write-off methods. The allowance methods means we do not directly credit accounts receivable. Instead, we use a contra assets account, which called allowance for uncollectible accounts. I also call it allowance for doubtful accounts. Instead of credit the accounts receivable directly, we credit these accounts. Since it is a contra assets account, the net book value of accounts receivable also reduced. But we do not reduce the accounts receivable account directly. Here in this example, in the balance sheet, you always see the accounts receivable are recorded for the certain amount. Here is less allowance for doubtful accounts, 226 for 2019. So actually, this amount is a difference between the gross amount of accounts receivable less 226. The net book value of accounts receivable or net realizable of accounts receivable was 14,481. So actually, no, the accounts receivable was 14,707. Allowance methods, we will proactively recognize bad debt expense and the credit allowance for doubtful accounts based on estimate. And later, when there is a specific amount to be written off or they are actually uncollectible, we will write off account receivable then. Let's take a look at how allowance methods works. So here the company has sales 1.2 million, collection was 895, so the difference will be the amount of credit sales, accounts receivables. Originally, credit sales was 1.2 million, 895,000 was collected. The balance of accounts receivable at the end of this year was $305,000. For the allowance methods, we should estimate how much this will not be collected. In this section, we do not calculate the amount, we just borrow the given amount. I will introduce the methods to determine the amount in the following section. It indicates 280,000 out of the 305 will be collected. $25,000 will not be collected. So this is estimate amount, okay? So we're going to debit $25,000 bad debt expense. This is an expense, okay? And credit the control assets accounts, allowance for doubtful accounts. See, here we do not credit accounts receivable directly. No. That's only for write-off. We credit allowance for doubtful accounts. We also assume the beginning balance of allowance for doubtful accounts was 0. So after this journal entry, its book value is credited to 25,000. So the net book value of accounts receivable is this. First, accounts receivable balance was 305,000. That's what I call it here. And allowance for doubtful accounts is credit 25,000. So the net book value of accounts receivable is the difference of these two. It's $280,000. Instead of direct write-off here, I reduce the book value of accounts receivable directly. Yeah, we record this in the allowance accounts, allowance for uncollectible accounts. The reason is this amount is a estimate amount. So the credit sales was $1 million, collection 760,000. So the balance of accounts receivable 240 as of December 31st, 2024. And estimate 200,000 will be collected. So 40,000 will become bad debt expense. So we are going to debit bad debt expense $40,000 and credit allowance for doubtful accounts. The net book value of accounts receivable was still $200,000 was difference of these two accounts. Next, in the following year, when the information is updated from the customer, the company learned $15,000 will not be received from the customer because the customer has gone bankrupt. So since this is a confirmation from the customer, and this is now estimate, okay? So the $15,000 will not be collected for sure. Then we're going to debit allowance for doubtful accounts and credit accounts receivable. So the purpose of this journal entry is to write off accounts receivable directly. The reason is $15,000 was not estimate. It is based on the fact. This journal entry does not have impact on expense. Instead, it just affects the contra assets accounts. After posting these two information in these two accounts receivable, because this write-off is reduced to $290,000. Allowance for uncollectible accounts, so we debit $15,000. Now its balance is $10,000. After this write-off, what we find is net book value of accounts receivable is still $280,000. In other words, this journal entry write-off does not have impact on assets balance and expenses. For accounts receivable, this journal entry write-off the accounts receivable directly. For the allowance for uncollectible accounts, the estimate become real. So we reduce this balance by $15,000. In other words, there are only $10,000 left as estimate to be uncollectible. Occasionally, a receivable that has been written off later can be reinstated. If this happens, it is very simple. We just make a reverse journal entry for this one. We debit accounts receivable and credit allowance for doubtful accounts. And then another journal entry which was not shown here, the company will debit cash and credit accounts receivable $1,200 because the reinstate. Because the accounts receivable finally will be realized. In summary, we have 3 journal entries, 3 different accounting treatment for under allowance methods. First is we estimate the uncollectible amount. So we will debit bad debt expense and credit allowance for doubtful accounts. This is why we name it as allowance methods. The reason we do not credit accounts receivable, as I said, because this amount is estimate. By making this adjusting journal entry, we can avoid the accounts receivable to be overstated, bad debt expense to be understated. The next journal entry is write-off. Write-off is based on the fact. So what we do is we debit allowance for doubtful accounts and credit accounts receivable. Why we say this is a write-off? Because we write off these assets directly instead of the control asset account. The next one is reinstate or recovery. So the recovery, basically we will reverse this journal entry for write-off. The reason is the recovery is from prior write-off. So if it is recovered, we will reverse the journal entry, making this one, and debit cash, credit amount has been recovered.